This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Welcome to Phase 2. If you completed Phase 1, you already know more about reading charts than most retail traders ever learn. You can read a candle, you can identify the trend, you can mark levels, spot patterns, plan the trade, and size the position. That is a real, complete framework. But here is the honest truth. Price alone only tells you half the story. Think about it this way. Imagine you see a stock breaking out above resistance. The candle is big, it is green, it is convincing, so you buy. But what you do not see is that almost nobody actually traded on that bar. The volume was tiny, and within 2 days the breakout fails and price drops right back below the level. Now imagine the exact same breakout, same stock, same resistance level, but this time the volume bar is 3 times normal. That is a completely different situation. That breakout has conviction behind it. Real money, institutional money is driving it. The candle looks the same in both cases, but only one of them is real. The difference is volume. And learning to read it is the single biggest upgrade you can make to everything you already know. In this lesson, we are going to break down exactly what volume is, why it matters, and how to start using it immediately to filter out the traps that burn beginners every single day. This is the layer that makes your Phase 1 toolkit sharper, more precise, and far more profitable. Let us get into it. Let us start at the very beginning. What is volume? In the simplest terms, volume is the total number of shares or contracts that were traded during a given time period. If you are looking at a daily chart, each volume bar tells you how many shares changed hands on that day. On a 5-minute chart, it is how many shares traded in those 5 minutes. Think of price as what happened and volume as how much conviction was behind it. Price is the headline, volume is the evidence. A big green candle tells you buyers pushed the price up, but volume tells you whether that push came from 1,000 retail traders tapping buy on their phones, or from Goldman Sachs and Citadel loading a 1,000,000-share position. Those are fundamentally different events, and they lead to fundamentally different outcomes. Here is the analogy I want you to carry through this entire phase. Price is the car, volume is the fuel gauge. A car can coast forward for a while on fumes, but if there is no fuel in the tank, it is going to stall. That is exactly what happens when price moves on low volume. It looks like movement, but there is nothing behind it, and it runs out of gas. And here is why this matters so much for the stocks dominating the market right now. The AI names, the semiconductor stocks, NVIDIA, AMD, Broadcom, the SMH ETF. These stocks move fast and they move big. Some of the biggest daily moves you will ever see happen in this sector. But not all of those moves are created equal. Some have real institutional volume behind them, and they follow through for weeks. Others are just retail noise on a slow afternoon, and they reverse the next morning. Volume is how you tell the difference. It is the X-ray vision that lets you see through the candle and into who is actually participating. Now let us look at what a volume bar actually looks like on a chart. Below every candle on your chart, there is a vertical bar. That bar represents the total number of shares traded during that candle's time period. Tall bar means lots of shares changed hands. Short bar means very few. It is that simple. But the question most beginners ask is, high compared to what? And that is the right question. Because 1,000,000 shares on Apple is a slow Tuesday, but 1,000,000 shares on a small-cap biotech stock is a once-a-year event. Volume is always relative. What you are looking for is unusual volume, bars that are clearly larger or clearly smaller than the recent average. The fastest way to do this is to add a moving average to your volume bars. Most platforms let you add a 20-period average line right on the volume panel. Any bar that towers above that line is above average volume, and that is when you pay attention. Any bar that barely registers below the line is below average, and that is when you stay cautious. You do not need to memorize exact numbers. You are looking for the visual contrast, the spikes that jump off the chart versus the flat, quiet bars that blend in. The spikes are where the story is. Now let us put this into practice with one of the most powerful volume applications, confirming a breakout. You already know from Phase 1 that a breakout happens when price pushes through a resistance level. But here is what Phase 1 did not tell you. Not all breakouts are real. In fact, a huge percentage of breakouts fail, and the single best filter for separating the real ones from the fake ones is volume. The rule is simple. A breakout on high volume is far more likely to be real. A breakout on low volume is far more likely to fail. Why? Because when price breaks above resistance on a surge of volume, it means a massive number of buyers just committed. They are voting with their money. They are saying, I believe this stock is going higher, and I am willing to bet on it right now. That kind of participation creates momentum. There are now thousands of new positions that need the stock to keep going up. But when a stock barely trickles above resistance on tiny volume, who is actually buying? Almost nobody. It might just be a few retail traders chasing the move. There is no institutional commitment, no fuel behind it. And without fuel, the car stalls. The stock drifts back below resistance, and everyone who bought the breakout is now underwater. Think about the AI stocks that ran in 2023, 2024, and into 2025. The breakouts that held, the ones that turned into multi-month rallies, almost always started with a volume surge that dwarfed the prior bars. That was the tell. That was the hidden signal. Let us look at the other side, the trap. And this is where volume literally saves you money. Imagine a stock has been testing a resistance level 3 or 4 times. The chart looks bullish. Everyone on social media is screaming about the breakout. Then one day, a green candle pokes above the level, but you look down at the volume bar and it is tiny, below average, maybe half of what the previous candles had. That is a red flag the size of Texas. What this tells you is that the breakout has no real participation. It is a head fake. And within the next few candles, price rolls right back down below resistance, trapping everyone who bought the break. This happens constantly. I cannot stress this enough. False breakouts on low volume are one of the most common traps in all of trading. And the beautiful thing is, you can avoid almost all of them just by checking one thing, the volume bar. Before you enter any breakout trade, ask yourself 2 questions. 1. Is the volume bar clearly above the recent average? 2. Is this volume bar among the largest in the recent range? If the answer to both is no, you do not take the trade. You wait. Let the trap spring on someone else. Quick pause. If you are serious about leveling up, not just in trading but in your career, check out Resume Zenith. Clean professional resumes, built fast. Link is in the description. And if this series is helping you learn, do me a huge favor. Hit that like button, subscribe, tap the bell. It takes 2 seconds and it genuinely helps get these free lessons in front of more people who need them. Back to volume. Here is where volume starts to supercharge everything you learned in phase 1. Remember all those candle patterns? The bullish engulfing, the hammer, the shooting star. They are good signals on their own, but they are great signals when they come on high volume. Think about a bullish engulfing at support. You already know that is a solid buy signal, but what if the volume on that engulfing candle is twice the average? Now you are looking at a candle pattern backed by serious participation. It is not just the pattern suggesting a reversal, it is the volume confirming that real buyers stepped in with force. That is a much higher probability trade. On the flip side, if that same bullish engulfing candle appears on low volume, it is a weaker signal. It might still work, but the conviction is not there. And that means you should either wait for more confirmation or skip it entirely. This is the upgrade. You are not changing what you look for. You are adding a confidence filter. Same candle patterns, same support and resistance, same trade plans. But now you are asking, does the volume back this up? If yes, you trade it with confidence. If no, you wait. This single habit will dramatically cut down the number of losing trades in your journal. Let me give you a practical rule of thumb for gauging volume. Add a 20-period simple moving average to your volume panel. Most charting platforms, TradingView included, let you do this in about 3 clicks. Once that line is on your chart, your volume reading becomes almost automatic. If the current volume bar is above the average line, there is above average interest. The more it towers over the line, the more significant. 2 times average is noteworthy. 3 times average is an event. If the bar is below the line, interest is low. Be cautious with any signal, breakout, or pattern that happens on below average volume. And here is a quick advanced tip. Pay extra attention to volume that spikes at the end of a move, not at the beginning. A surge of volume at the start of a trend is bullish. It is fuel. But a surge of volume after a stock has already run far? That can be exhaustion, a sign that the last of the buyers are piling in right before the top. We will dig much deeper into that in the next lesson. For now, just add that 20-period average and start training your eyes to spot the spikes versus the silence. And one more practical tip. When you are comparing volume bars across different stocks, do not compare absolute numbers. 1 million shares on NVIDIA is completely different from 1 million shares on a penny stock. Always use the relative comparison, current bar versus its own recent average. That is why the moving average line is so valuable. It automatically adjusts for each stock's normal activity level. A bar that is 2 times its own average is significant regardless of whether the stock trades 100,000 shares a day or 100 million. Let me bring this full circle with a real-world lens. Think about the semiconductor and AI stocks that have dominated the headlines. Stocks like NVIDIA, AMD, the SMH ETF. These stocks have had massive rallies, but they have also had plenty of false breakouts and sharp pullbacks that trapped people. If you had been watching price alone, Many of those fakeouts looked convincing. The candles were big, the moves seemed real, but the volume told a different story. The breakouts that actually held, the ones that kicked off multi-week rallies, came on volume bars that dwarfed everything around them. It was obvious just by glancing at the volume panel that something different was happening. And the fake breakouts? Tiny volume bars, no participation. The smart money was not there. Here is the mindset shift I want you to make. From today forward, you do not look at a candle without checking the volume underneath it. Price tells you what happened. Volume tells you whether it matters. Those two pieces of information together are more powerful than a dozen indicators stacked on top of each other. You do not need RSI, MACD, Bollinger Bands, and Fibonacci all at once. You need price action and volume. That is the language of the market. Everything else is just a translation. Here is your homework for this lesson, and it is genuinely going to change how you see the charts. First, open TradingView and pull up any chart. It could be NVIDIA, AMD, the S&P 500, anything. Second, add the volume panel if it is not already there. On TradingView, just click on the indicators icon and search for volume. Add it. Third, add a 20-period moving average to the volume panel. This gives you that average line we talked about. Fourth, scroll through the last few months and find 3 breakouts. For each one, check the volume bar. Was it above average or below? Did the breakout hold or fail? Write down what you notice. I promise you, within 10 minutes of doing this, you will start to see the pattern. The breakouts that hold tend to come on big volume. The ones that fail tend to come on small volume. It is not 100%, nothing is, but it is a massive edge. Then for extra credit, find 3 candle patterns you recognize from phase 1, a hammer, an engulfing, a doji, and check the volume on each one. Was the volume above or below average? Did the patterns with higher volume lead to better follow-through? Start building that mental database. The more examples you see, the faster this becomes second nature. And the free cheat sheet for this lesson, with the volume checklist and all the rules, is at candlelogictrading.com. And that is the foundation of volume analysis. You now understand what volume is, why it matters, how to read a volume bar relative to the average, and how to use it to confirm breakouts, filter out traps, and add conviction to your candle patterns. This is the layer that separates the traders who get faked out constantly from the ones who see the trap before it springs. In the next lesson, we go deeper into one of the most dramatic volume events on the chart, Climax volume, the massive volume spikes that signal exhaustion, blow-off tops, and selling climaxes. These are the bars that appear right before major reversals, and learning to read them can keep you from buying the top and selling the bottom. It is one of the most valuable skills in all of trading. So subscribe, tap the bell, and I will see you in Lesson 12. New lessons drop every Sunday, Tuesday, and Thursday. If this helped you, hit that like button and share it with someone who needs to hear this. Go practice, protect your capital, and I will see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.